The valuation dashboard presentation for the weekend of the 24th of August. What I wanted to do this week, it's obviously been a very volatile week on the markets. We've seen a lot of price swings and changes in valuations. However, rather than sort of marveling at the volatility that we're seeing, what I'd like to do is focus on some of the this time it's different themes that I've been pulling out in the chart of the week over the last couple of weeks, and sort of bring them together and look at some possible conclusions from that. First, the chart I'm showing here is the price earnings ratio on the market, inverted, so basically an earnings yield, and I'm subtracting away the bond yield. So when this gets high, we're talking about cheap equities. When it's low, we're talking about expensive equities. So back in the late 2006, 2007, we're looking at the difference between earnings yield and bond yield being that in that 1 to 2% range, and a little bit lower. We hit the crisis, it blew out to 5 to 7%. Things returned to normal, and we got back to that sort of. We did get back down to the 0 to 2% range, but in the last little while we've been trading around that 2 to 4% range. Now things have blown out again. So certainly within equity markets and bond markets in aggregate, we're seeing pricing for risk. So prices of equities way down, and prices for bonds, government bonds, way up. However, when we start digging a little bit deeper into into these markets, first, what I'm showing here is the large cap PE ratio versus the small cap PE. So basically, when this number is high, we're talking about large caps trading at a premium, or people paying more for large caps than what they will for small caps. Our target range is in that sort of 1 to 2 times band, and we've seen that over time, people do tend to pay more for large caps. In that 2006-2007 period, we got right down there in terms of large caps and small caps. We're close to parity in terms of what they were trading at, and this ratio was all within our preferred band. When the crisis hit, that blew out. So people were much happier to be in large caps, and they were very, very risk averse, avoiding the small caps. We haven't seen that this time around. We're still seeing largely within our band and at levels that you certainly wouldn't expect for the given that we're in given how far equity markets have fallen. We then see a very similar theme in corporate bonds, where in corporate bonds we're looking now at credit spreads, so the difference between corporate bonds and government bonds. We see that when crises happen, whether it be oil crises or wars or depressions, these credit spreads blow right out. So this is where we reached during the recent credit crisis. Not seeing it again. So again, things are pretty normal in terms of the corporate bond credit spread front. If we look at the cost against the cost of insuring against default for corporate bonds, yes, it's certainly ticked up in the recent past, but nowhere near the heights it hit during the crisis as well. So the same story there for CDS. And then we see inflation-linked bonds, so implied inflation based on market pricing, and you can see that where we hit during the crisis is that when we have these crises and people worried about deflation and markets going and economies going to recession, we see that markets start pricing inflation at the lower end of the band, whereas the RBA has a target of 2 to 3%. We're at 2.7% effectively, so still in the upper half of that band for what people are pricing inflation. So I guess the real question comes then, what does this mean for markets? So we're seeing that markets generally are well down. However, when we look at the nuances of it, what we're seeing is the higher risk assets within these markets haven't really been as affected. So I guess there's a couple of possible conclusions from it. I think one of the tactics certainly going and we'll go into those in a little bit more detail over the coming weeks. But one of the ways that it suggests to me that we should be looking to play this crisis is within the higher quality end of the market, because if things get dramatically worse, we could certainly see the lower quality or the more risky assets drop a lot more in price. And if things get better, we're probably going to see a relatively equal recovery in both higher quality assets and lower quality assets. So lower risk seems to be the way to play this crisis.